Marcus Warren is my go-to for a successful retirement, but it's one thing when I ask him questions. It's quite another when you're able to ask him questions, and we're going to do that today. Marcus Warren again from Warren Wealth Management. Welcome back in, Marcus.
Thank you.
You were talking about your weekend. You had a good one. You say the kiddos played some sports, and your dad was there to support them?
Yeah, sports are back in full effect. Football game and 2 volleyball games. So, yeah, all my weekends now are going to be busy weekends now moving forward. A good dad and a great financial planner and a great man when it comes to taxes. He's what you need if you're looking for a successful retirement, and who isn't? Okay, Marcus, you don't mind this, do you? I mentioned that I'm going to throw some questions at you. Okay.
Could be about taxes, could be about wealth management. Either way, probably about a successful retirement. You ready?
Sounds good.
All right, here we go. Here's the first one. This is from Roy, 60 years old. So he's right there getting ready for retirement of Louisville. He says, over the last year, my IRA made 18%.
Nice.
But my annuity only made 2%. Should I get rid of my annuity and put my money in the IRA? Good question.
Yeah, it is a good question. And Roy, he's probably comparing apples to oranges, and so he says his IRA made 18%, so I'm assuming that it was probably in the market, mutual funds, things of that nature, and there's a relative risk that's associated with even achieving that 18%. And then he has this annuity, and I'm going to assume again, because I don't know Roy's specific situation, that it's probably some sort of fixed annuity, fixed indexed annuity, something like that. And so when I say he's comparing apples to oranges, what investors need to think about when they're looking at their return, they have to compare it to the relative risk that they're taking to get that return. And so that annuity is it's a guaranteed investment. It's 100% safe. You cannot lose money. Thus, probably the lower returns, because with an annuity, because they're giving you complete safety and you can't lose any money, they are going to cap or limit what you can make on the upside. Thus, his 2% return. On the flip side, his IRA that was in the market, it was up 18%, but it could have easily been down 18%. And so I would say, Roy, just without knowing your specific situation, you probably don't want to just do what I call hindsight investing, when a year passes and you look and you see those big returns, and then you look at all of the ones that didn't do that great and you want to dump all your losers or all the ones that had low rates of return into the winners. And then what happens is the next year those winners turn into losers, and then you get into this game. Stick with your plan, stay with your plan, don't get into all that hindsight investing, and you'll probably be out on top.
All righty. Here's the next one. Marcus, I retired in June this year, and I haven't taken any money from our retirement accounts yet. We have been living off my husband's income. I have all of my retirement savings in my 401k. Should I move this to a Roth? This is Mary Ann, who is 64 years old, from right here in Louisville.
Okay, Mary Ann. So if you listen to me podcast, or if you see me on this show, you know that I advocate higher taxes in the future and potentially moving money from that tax-deferred bucket. And I'm assuming she has money in her IRA 401k, and she wants to convert it and move it over to a Roth. I would pump the brakes a little bit here, simply because, and obviously she probably needs to talk to her tax advisor, and if she needs help from me, she can always get in contact with me too. But when you are looking to move money from an IRA to a Roth, that is a taxable event. So if you do it all in one fell swoop, you're going to have a big tax bill. You said your husband's still working, which means that there's income coming in. So you moving money over to that Roth could put you in a higher tax bracket, and you're paying this big tax bill that you might not be ready for. The way that we do it in our office, if it fits a client's needs, we are going to systematically and efficiently move money from that tax-deferred bucket to the tax-free bucket, and we do that over a period of time. Take, for instance, we have a client that we're working with in the office. We've been doing this, moving money over for a couple of years already. And that's averaged out to be about $150,000 or so each year. But we're saving them. Right now they're in that 24% tax bracket. If no changes are made, they're automatically going to jump when the tax cuts expire from the 24% bracket to the 32% bracket. So we're saving them, in essence, about $12,000 or so each year that we're making these changes, right? And so that's going to be a lot of money in the long term. And then when you add opportunity cost on top of all that, what that $12,000 each year of savings could make in the market if they're able to invest it, average 8% over a course of a 30-year retirement, it's going to be well over, I think it's around $1.2 million is what they could potentially have in those tax-free earnings simply because of being proactive and moving money from that tax-deferred bucket to the tax-free bucket. Now, for Marianne's sake, probably needs to talk to a good tax advisor, but she's on the right track. She's on the right track because taxes will go up in the future.
Yeah, that's a significant amount of money. All right, here's the next letter. It says, I have a weird problem. I have some UPS stock that I really want to sell because I've made a lot of money over the years, but I'm worried about the tax bill that I have to pay when I sell it. What should I do? Willie is 59 years old, and he is from Prospect.
Okay, Willie. I would say this. So you'd never want to let the tax tail wag the dog, right? Wag the investment dog, meaning that if you have big gains, you still have gains, right? Albeit they're going to be capital gains. And the thing about when you have money outside of a company retirement plan and it appreciates, you're paying the more favorable capital gains rate, which is anywhere between 0 to 20%. So I would tell Willie, hey, potentially take some earnings off the table if it's going to work out. And then you need to work with a good tax advisor, investment advisor. Maybe you have some other stocks that haven't done so well. Maybe they have lost money, so you can do what's called tax loss harvesting, where you can sell your winners and offset some of those gains with the losses, and so you don't have as big of a tax bill. So there's a lot of things you can do, but I would never let the tax tail wag the investment dog, because in the long run, you want to make money.
All right, we've got a quick one, if we can do this in about a minute. So I'm trying to set up an account so that I can roll over an old 401k. What's the difference between all the different companies? There's Fidelity, Charles Schwab, TD Ameritrade. Who has the best investment options? Sheila, 55, she's from Jeffersonville. All right, here we go.
All right, yeah, this is an easy one, Sheila. So Sheila, generally TD Ameritrade, Charles Schwab, Fidelity, they're custodians. They basically just house and hold the money, and then you can invest it any way you want. So there's no real difference between any of them. As far as investment options, Fidelity may have their specific proprietary investments, but for the most part, when you're utilizing a Schwab, a TD Ameritrade, Fidelity, it generally doesn't matter. You just have to make sure you have a good advisor advising you on those accounts.
So whether it be a financial advisor or a tax advisor, he does it all. Warren Wealth Management, Marcus Warren, a great resource. And if you'd like him to answer your question, perhaps the next time he comes on, you can go to warrenwealth.net, warrenwealth.net, or you can give him a call for an appointment. If you'd like to chat with Warren yourself, a consultation. 502-622-1337, or again, visit warrenwealth.net. We encourage you to sign up and subscribe to his podcast. There is the podcast information right there. Marcus, thank you so much. Really appreciate it.
Thank you.